Welcome to Iron Financial. Our mission is simple, to help you forge a stronger portfolio and cut right through market weakness. Today, we're putting ONEOK under the microscope. You see, this company just went on one of the biggest, most aggressive shopping sprees in the energy sector, and now, well, the bill is coming due. So we need to find out, did they build an indestructible fortress, or did they just build a house of cards?
Right there, you're looking at the victory speech from CEO Pierce Norton. Now listen to the language. It's precise, it's designed for Wall Street. He's using all the key phrases: double-digit growth, synergy capture, integrated systems. He's painting a picture of a flawless victory lap after a massive buying spree. But of course he is. No CEO is going to get on an earnings call and say, hey, we just spent tens of billions of dollars and we're really hoping for the best. This is corporate messaging 101. It's a message of strength, of control. But our job here is to look past the message and inspect the machine itself.
And yeah, on the surface, the numbers definitely back him up. I mean, we're talking about $8.02 billion in adjusted EBITDA. That's an 18% jump from 2024. Now, this isn't just some small incremental growth. This is a quantum leap in earning power. It's the kind of number that makes analysts sit up straight in their chairs. And when you look at diluted EPS, which is what actually hits the bottom line for shareholders, it's up a powerful 11%. These are, without a doubt, heavy-hitting stats. But stats can be misleading. They force every analyst to update their models, for sure, but they don't tell the whole story.
Exactly. Let's pump the brakes for a second. Any company can post huge growth numbers after just bolting on billions in acquisitions. You buy a company, you get to buy its earnings. It's just simple arithmetic. The real question, the one we absolutely need to answer for our portfolios, is whether the foundation is solid. Is this genuine organic strength, or are we just looking at a paper tiger that's been puffed up by M&A? Did they actually build a skyscraper, or did they just build it way too fast on a really weak foundation?
That is the only question that matters. So today, we're putting this company through the full Iron Financial stress test. First, we're going to examine how this behemoth was actually built, piece by massive piece. After that, we're popping the hood to stress test its financial engine. We're talking the cash flow, the revenue streams, everything. Then comes the really critical part. We're going to actively look for cracks in the armor. And before we deliver our final verdict, we'll examine their blueprint for 2026 to see if they're actually reinforcing the structure or just patching it up.
So, to understand those 2025 numbers, we first have to understand the massive construction project that ONEOK undertook. And this wasn't a simple renovation, okay? They tore the company down to its foundation and rebuilt it with entirely new components. They fundamentally changed its corporate DNA in just a couple of years. And you know what? When you change that fast, you introduce risk, a lot of it.
This is not your old ONEOK. The Fintra report, I think, correctly calls it a titan of the midstream landscape. For years, they were the undisputed king of natural gas liquids, a highly profitable, very focused specialist. Now, they've gone from being that specialist to what they call a wellhead-to-water service provider. So let's just break that down for a second. Wellhead-to-water means they want to control the journey of every single molecule, from the second it comes out of the ground to the moment it's loaded onto a ship for export. It's a bold play for total dominance across multiple commodities: NGLs, crude oil, refined products. It's incredibly ambitious, but it's also a massive strategic pivot that could potentially spread them way too thin. And they executed this pivot through a truly historic consolidation phase, a real triple play of acquisitions. It all started in September 2023 with a foundation-shattering $18.8 billion merger with Magellan. Now, that wasn't just buying a competitor, that was buying an entirely new business line in refined products, like gasoline and jet fuel, plus all the crude oil infrastructure that came with it. Then, while the market was still trying to digest that massive deal, they delivered a 1-2 punch in late 2024, absorbing both EnLink and Medallion. This wasn't about diversification anymore. This was a surgical strike to establish overwhelming dominance in the Permian Basin, the most important energy field in North America. This was a complete rebuild of the company's asset base and its future cash flow profile, all done in about 18 months. That's moving at light speed.
All right, so we've seen the massive new structure they've built. Now we need to pop the hood and inspect the engine. We have to determine if this new machine is powered by a high-performance, truly integrated system, or if it's just cobbled together with a bunch of mismatched parts that could fail under pressure. This is where the hype meets reality. Let's see the numbers.
The core of the bull case is right here. This is the bedrock of their entire financial structure. 90% of their earnings are fee-based. Let me be crystal clear about what that means. ONEOK gets paid for the volume of energy that moves through its pipes, not the volatile price of that energy. It's basically the toll booth operator model.
While oil and gas prices are on a wild roller coaster, ONEOK is just collecting cash on almost every molecule that passes through. It provides a solid, predictable foundation of cash flow, which is exactly what you need to support the mountain of debt they took on to build this empire. This stability is absolutely non-negotiable for their strategy to work.
And this just brilliantly illustrates that fee-based growth. Let's drill down a little deeper than the headline numbers. Net income that's attributable to the company is up to nearly $3.4 billion from just over $3 billion. And look at operating income, the pure profitability of their core business, jumping from under $5 billion to over $5.7 billion. The engine isn't just running, it's running hot, and it's showing real year-over-year horsepower. The output from that 90% fee-based model is just undeniable. But you know, horsepower is only useful if the transmission can actually handle it. We still need to see if the rest of the chassis is sound.
And it's not just one engine. When you break it down by segment, you can see the diversification they bought. This is the new ONEOK. Natural gas liquids, their legacy business, is still the core, bringing in a massive $2.78 billion. But look at the other pillars. The Magellan acquisition brought in a brand new $2.18 billion engine from refined products and crude. And the EnLink and Medallion deals supercharged the gas gathering and processing segment to $2.14 billion. I'll grant you, it's a well-balanced, multi-cylinder machine. On paper, it's designed to keep firing even if one segment faces a headwind. The question is whether they can keep all those cylinders tuned and running smoothly at the same time.
So the crucial point is, they are delivering on their promises. When a company makes huge acquisitions, they sell a story of synergies, cost savings, new revenue opportunities, and most of the time it's just talk from a slick PowerPoint deck. But here, it's reality. They've already managed to squeeze out $475 million in real-world synergies, and that's a strong number. It shows they are actually finding efficiencies, cutting redundant costs, and connecting their new systems to create more value. This isn't just theory, it's disciplined, on-the-ground execution, and that's a major point for the bulls.
And that's an impressive bull case. It's a story of scale, of stability, and of execution. But at Iron Financial, we don't just admire the fortress, we test its walls. Every structure, no matter how imposing, has a vulnerability. Now it's time to put this new ONEOK under some real pressure and see if we can find any cracks in the armor. This is where we separate a good investment from a great one. Let's see the bear case.
The arguments clash directly. On one side, the bulls see unstoppable volume growth. More gas, more liquids, more products flowing through the system, all driven by their new scale. But the bears are looking at the bigger picture. They're worried about a broader slowdown in U.S. natural gas production. They also point to operational headwinds, like weaker ethane recovery, which sounds like a technical issue, but it's one that could directly impact future revenue streams. It's the macro-level view versus the company's specific execution.
And here's the first major stress point: the debt. This is the number that keeps the bears up at night. They ended the year with a net debt to EBITDA ratio of 3.8 times. Now, to be fair, management is paying down debt aggressively. They extinguished nearly $3.1 billion in 2025 alone. They know this number is high and they're attacking it. But 3.8x is still a significant load to carry. It leaves less room for error. If the market turns, if volumes dip, or if interest rates spike again, that debt load becomes a very heavy anchor on the balance sheet. This is the price they paid for their empire, and the payments are steep.
And the risks don't just stop at the balance sheet. First, you have integration risk. They aren't just integrating one company, they're juggling 3 massive new pieces at the same time. The operational complexity is just off the charts. One slip-up could be incredibly costly. Second, the regulators are watching. The era of easy mega mergers is over. The DOJ and the FTC have made it very clear they're scrutinizing these deals, which means the primary growth engine ONEOK just used, large-scale M&A, might be shut down for the foreseeable future. And finally, there's a crack visible in their very own guidance. They assume a low commodity price environment for 2026. And while their earnings are mostly fee-based, their customers, the producers, are not. Low prices force producers to slow down drilling, which means lower volumes flowing through ONEOK's system. They are completely reliant on their customers' health.
Valid points. Very valid. A great company doesn't just rest on last year's results, and it certainly can't ignore its risks. So let's move to the 2026 blueprint. Let's see how management plans to address these cracks, reinforce their position, and continue to build on this new, larger foundation. Let's see if they're building or if they're just patching.
Their guidance shows they expect to hold these high levels. This is a really powerful statement. They're not projecting a fallback after the acquisition bump. The midpoint for adjusted EBITDA is $8.1 billion, essentially locking in the massive gains from 2025. This tells us that management believes the new earnings level is sustainable. They are building a new, higher foundation for the entire company.
You know, I see it a little differently. After spending tens of billions of dollars, they're guiding to essentially flat year-over-year EBITDA growth. You could argue they spent all that capital just to tread water at this new, higher level. Is that enough of a return on that massive investment? That's the question.
And they do plan to grow from here by putting serious capital to work, up to $3.2 billion in 2026. This isn't just for upkeep. They're rebuilding a key NGL facility, expanding their new refined products network near Denver, and adding more gas processing capacity in the Permian. And that last point is key, building out export infrastructure. They're trying to shift from an M&A growth story to an organic growth story, with a focus on connecting U.S. energy to the global market. That's the right move, but these are complex, multi-year projects. Execution is everything.
And here are the catalysts that could drive the stock higher. First, more synergies. They've promised another $150 million on top of what they've already achieved. Second, a clear plan to attack the debt and get that leverage ratio down to a more comfortable 3.5x. Third, a powerful new demand story from the AI revolution. Data centers are the new factories, and they run on power, which means natural gas. ONEOK is perfectly positioned to supply them. And finally, a 4% dividend increase. Management is signaling that their cash flow is strong and getting stronger. But these are all future catalysts. They still have to deliver on the synergies, hit that debt target, and wait for the AI demand to actually materialize. It's a compelling story, but it's not a guarantee.
All right, we've laid it all out. We've stress-tested the engine, we've inspected the foundation, and we've looked at the blueprints for the future. The bull case and the bear case are on the table. The evidence has been presented, so what's the final verdict? Is this a well-constructed opportunity or a cleverly disguised portfolio trap?
Well, Wall Street is cautiously optimistic but deeply divided. Just look at this breakdown. A clear majority of analysts, 57%, rate the stock a hold. That's telling. They see the strength, they see the massive jump in earnings, but they also see the risks we've outlined, the debt, the integration complexity. A hold rating is Wall Street saying, show me. They're waiting for more proof of execution before fully buying into the new structure. But it's important to note that over 40% are in the buy and strong buy camps. The bulls are there, they just aren't the majority yet.
So here's the final tally. The strengths are formidable. They have a dominant, now highly diversified asset base. The 90% fee-based earnings model is a fortress of stability. And they have a management team that has proven it can execute on complex synergies. But the weak points demand respect. That debt load is still high at 3.8 times leverage. Integrating 3 major companies at once is an operational nightmare waiting to happen if not managed perfectly. And their future growth is now handicapped by regulatory headwinds and their ultimate reliance on the drilling activity of their customers. You have to weigh these two sides very carefully.
The verdict from Iron Financial is this. ONEOK has done the heavy lifting to build a true midstream powerhouse. This has shifted from a merger story to an execution story. Management has made its big moves, now it's all about proving they can run this new, larger, more complex machine effectively. For investors, the opportunity is compelling, but this is not a set-it-and-forget-it stock. It's a structure you have to monitor closely every single quarter for any signs of stress in that foundation, any slip in synergies, any delay in paying down debt, any slowdown in volumes. Management has forged a giant. The ultimate question we leave you with is this: is its foundation strong enough for your portfolio?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.